So it seems that worry in the markets has eased a bit after that knee-jerk reaction we saw on Friday, but now we have another week of important data coming up. The biggest will of course be the US NFP release on Friday, that's the employment situation in the US, and we'll cover that in a video a bit later in the week. We also have another OPEC meeting this week, which is likely to disrupt oil prices, and boy oh boy did they get disrupted on Friday. But again, we'll cover that in a video later in the week as well, so make sure you're subscribed to the channel so you don't miss those ones. But before all of that, we have other important data coming up, with Eurozone inflation figures coming out on Tuesday, that's tomorrow, and those are expected to show us that inflation in Europe has hit the highest level since the euro was launched. In fact, the inflation rise is expected to match what we saw in the US and be at the highest level in 30 years, since 1991. But it has to be said, the situation in Europe and the US are very different, and we'll come on to that in a second. But first of all, let's focus on the numbers. So a poll of economists gave a range of expectations for the November CPI numbers, but the headline figure is expected to show about 4.4%. This would be up from the 4.1% we saw in October. However, core inflation, which excludes the volatile items of food and energy, is likely to show a rise of 2.3%. Now, as I mentioned, this is very different to the US. Inflation in Europe seems to be driven a lot more by energy costs. One estimate from Morgan Stanley has it at 2.2 percentage points of that 4.4% rise coming from energy. And this is a much higher proportion than the US. And it seems in the US, core inflation may be rising more than it is in Europe, since households had much more financial support from the government in the pandemic. And it's this difference in inflation that's partly behind the difference in policy stance between the ECB and the Federal Reserve. There's no doubt that when the data comes out tomorrow, many people will believe that this is a strong sign that ECB are going to have to raise rates sooner. We have and will have more ECB members and European policymakers in general giving hawkish signs and asking for the timeline to rate rises to be brought forward. But to be honest, that's really unlikely to happen. You see, although inflation is hitting higher levels than expected, these figures are expected to drop off quite soon. An assessment by economists at Bloomberg using their shock model shows that the ECB projections at their next meeting are likely to show that inflation is peaking at a higher level than expected, mainly due to higher energy costs and a weaker trade-weighted exchange rate. However, medium-term inflation is likely to be lower, and it's that part that the ECB will care about the most. You see, the ECB are much more worried about lasting damage to the economy, and that lasting damage is more likely to come from being stuck in a low inflation situation like Japan than the high inflation that they see as a temporary problem. They've struggled with low inflation for a long while now, so they may even see the current trajectory as being quite helpful for their long-term goals. Therefore, it's likely that Christine Lagarde, head of the ECB, will continue to say that inflation is transitory despite these high numbers. In fact, the current high inflation figures are considered to be partially artificial. In July 2020, to support the economy, Germany chose to cut VAT for 6 months. So that meant prices were lower from July until the end of the year. So current year-on-year inflation figures are being compared to those lower prices. But we can expect year-on-year figures for inflation at the start of 2022 to be much lower than they are now, since those VAT cuts ended at the start of this year. So it's comparing something that's much more realistic. But whether inflation is coming from energy costs or the figures are artificially inflated, it doesn't mean that it's not an issue. The higher energy costs have actually got quite a widespread effect, even on the price of food. For example, natural gas accounts for about 80% of the variable costs of essential fertilizer components. The fertilizer industry in Europe is really struggling, and imports from other large producers are being restricted. So this could cause food prices to start going up even more, particularly from December onwards, because it's then that Russia restricts nitrogen and phosphate fertilizer exports for 6 months, that's starting in December, and potash exports from Belarus, which is a fifth of the world's supply, are being stopped due to delayed US sanctions, and I think those start from the 8th of December. So it's definitely not a straightforward situation, and after those CPI figures come out on Tuesday, we'll be shifting our attention to any comments from ECB policymakers and towards their next meeting to see if their language about this situation changes. In the meantime, EURUSD did stall at that monthly path of resistance that I mentioned before, and we're back now to seeing if it can close the month above those levels, and therefore we can start looking for higher lows over the shorter term, like intraday, seeing if we could pick up a long move. Although at the moment, with the uncertainty and the momentum we've had to the downside, particularly for the euro, we need to be paying attention to those negative filters, keeping an eye on our triad of price action to make sure we're not trading against any severe momentum or any high volume that could push us through those levels. And remember, until the close of the month, we haven't closed above those levels, so we could still break through them. But anyway, hit the thumbs up button if you found this useful or interesting. It really does help to support the channel, and we really appreciate it. Also, leave a comment below with your thoughts on Eurozone inflation, and let me know what markets you're following this week. And I'll see you in the next one. Take care, guys.